Welcome to Iraqi Dinar News, where you receive real and authentic updates about the Iraqi dinar. If you want to stay informed with moment-by-moment developments, make sure to subscribe to the channel and like the video. Today, we're taking a closer look at an important pattern that many Iraqi dinar followers have been discussing: the actions that typically precede a foreign exchange adjustment in Iraq. Specifically, we're analyzing the recent tightening measures by the Central Bank of Iraq and what they could mean in both the short term and the long term for Iraq's monetary stability and for those who closely follow the IQD. Historically, when Iraq has implemented significant foreign exchange policy adjustments, certain monetary behaviors have tended to appear beforehand. Looking back at 2015, 2020, and 2023, the Central Bank of Iraq introduced tighter controls over foreign currency transfers. These measures included restricting who could send money abroad, setting limits on transfer amounts, and requiring that transactions go through approved banking channels. Banks that did not comply with official mechanisms were restricted or cut off from participating in dollar auctions and foreign currency access. These actions were not random. They were part of a broader strategy aimed at strengthening oversight of the foreign exchange market, reducing capital flight, and stabilizing the domestic currency environment before making policy shifts. In each of those periods, Iraq was facing economic pressure, whether from falling oil prices, fiscal deficits, political uncertainty, or external shocks. The tightening of dollar outflows and enforcement of official platforms was designed to close gaps in the system and reduce parallel market distortions. Fast forward to today, and we are seeing similar patterns emerge. The Central Bank of Iraq is once again tightening control over foreign currency transfers. There are renewed restrictions on how dollars are accessed and transferred, increased scrutiny on compliance, and stronger enforcement against banks that do not follow official electronic platforms. The goal appears clear: reduce excessive dollar outflows, control speculative activity, and narrow the gap between the official exchange rate and the parallel market rate. It's important to understand what this actually means. When a central bank tightens foreign exchange procedures, it is typically trying to protect its foreign currency reserves and reinforce confidence in the local currency. In Iraq's case, oil revenues, denominated largely in US dollars, are the backbone of the country's reserves. The central bank converts a portion of these revenues into dinars to finance government spending. If too many dollars leave the system through unofficial channels, it creates pressure on reserves and widens the spread between official and street exchange rates. In previous cycles, such tightening measures have preceded exchange rate adjustments. However, it is crucial to approach this carefully. Correlation does not automatically mean an immediate rate change is imminent. What it does suggest is that the central bank is positioning itself for greater control and stability. Monetary authorities typically prefer to enter any exchange rate adjustment from a position of strength rather than weakness. Tightening the system first allows them to reduce distortions and increase transparency. In the short term, these measures often lead to friction in the market. Businesses that rely on imports may face delays or additional documentation requirements. Some banks may temporarily lose access to foreign exchange windows if they fail to comply. This can cause short-term volatility in the parallel market rate as demand adjusts to new compliance rules. We've seen in prior years that such transitions can create temporary upward pressure on the street rate before stabilizing once enforcement becomes consistent. For Iraqi dinar followers, the short-term implication is not necessarily about a sudden revaluation or devaluation. Instead, it's about structural tightening. When the central bank restricts dollar outflows and enforces official platforms, it is working to align monetary flows with regulatory standards. That alignment can strengthen policy credibility, which is essential before any formal rate policy change is considered. In the medium term, if the central bank succeeds in narrowing the gap between the official and parallel exchange rates, it enhances confidence in the banking system. A more stable exchange environment can attract foreign investment, particularly if investors see that currency risk is being managed carefully. Stability also supports domestic economic planning. Businesses can price goods more accurately, and government budgeting becomes more predictable. Looking at the longer-term picture, Iraq's broader economic reforms are central to any sustained currency strength. Exchange rate adjustments alone do not create economic growth. Structural reforms, diversifying revenue beyond oil, improving tax collection, modernizing the banking system, and strengthening anti-money laundering compliance are what ultimately determine long-term currency stability. Tightening foreign transfers is often part of a compliance-driven strategy that aligns Iraq with international financial standards. Another factor to consider is international oversight. In recent years, Iraq's dollar transactions have been closely monitored through international banking channels. Greater scrutiny has pushed the central bank to refine its processes and ensure that dollar sales are legitimate and documented. By forcing banks to use official electronic platforms and blocking non-compliant institutions, the central bank signals to international partners that it is serious about transparency. That credibility is essential for maintaining access to global financial systems. For IQD observers, it's essential to separate structural monetary reform from speculative expectations. When the central bank reduces dollar outflows, it is primarily protecting reserves and reducing illicit flows. While such actions can be a technical precursor to exchange rate adjustments, they do not guarantee a specific direction or timing. Central banks adjust exchange rates based on macroeconomic conditions, reserve levels, inflation trends, fiscal policy, and political stability. Inflation control is another important dimension. If dollar leakage fuels parallel market volatility, it can increase import costs and ultimately raise domestic prices. By tightening controls, the central bank attempts to anchor inflation expectations. A more stable dinar environment reduces imported inflation pressure, which supports consumer purchasing power over time. There is also a psychological component. Currency markets are influenced by expectations. When the public sees that the central bank is actively enforcing compliance and restricting irregular transfers, it can boost confidence that authorities are serious about defending the currency. Confidence itself is a stabilizing force. However, if restrictions are perceived as too harsh or disruptive, they can temporarily increase anxiety. This is why communication from the central bank remains critical. In comparing 2015, 2020, and 2023, each period had unique drivers. In 2020, for example, oil price collapse forced fiscal adjustments that eventually led to a formal exchange rate devaluation. In 2023, reforms were more compliance-driven, aimed at closing the gap between official and parallel rates. Today's environment appears to be more about regulatory tightening and alignment rather than an emergency fiscal response. That distinction matters. The key takeaway for Iraqi dinar followers is that tightening foreign exchange controls is a technical monetary action. It strengthens oversight, reduces leakages, and prepares the system for stability, it does not automatically signal an immediate revaluation, nor does it confirm a dramatic shift is around the corner. It indicates preparation, discipline, regulatory enforcement. Short-term, expect continued monitoring of parallel market spreads and compliance updates from the Central Bank of Iraq. Medium-term, watch for narrowing rate gaps and improved banking transparency. Long-term, sustainable currency strength will depend on Iraq's broader economic reforms, fiscal discipline, and diversification efforts. As always, responsible analysis means focusing on fundamentals rather than speculation. Exchange rate policy is complex and influenced by multiple macroeconomic variables. The tightening measures we're seeing are significant, but they are part of a larger economic strategy that unfolds over time. If you value balanced and factual coverage of Iraqi dinar developments, make sure to subscribe to the channel for responsible updates. And remember, this content is provided for informational purposes only and should not be considered financial advice.